Ladies and gentlemen, we need to have a very important conversation right now because something extraordinary is happening in the silver market. And the mainstream financial media is trying to scare you out of your positions at the worst possible moment. They are telling you that $5 billion in forced selling is coming. They are warning you that 13% of open interest is about to be liquidated. They are trying to create panic at the exact moment when the fundamentals have never been stronger. And I am here to tell you that this is the oldest trick in the book. This is how wealth gets transferred from weak hands to strong hands. This is how the institutions accumulate while retail investors panic. And if you understand what is really happening, you will see this for what it truly is. The ultimate buying opportunity in a market that just delivered its best year since 1979. Let me give you the numbers that the fearmongers do not want you to focus on. Silver just posted gains of approximately 160% in 2025. 160%. That is not a typo. That is the verified, documented performance of the metal that Wall Street has dismissed as the poor man's gold for decades. While the S&P 500 delivered solid returns, while gold posted a respectable 60 to 70% gain, silver absolutely crushed everything. It outperformed every major asset class. It validated every stacker who endured years of ridicule. It proved that the thesis we have been discussing for years was not just correct, it was conservative. And in late December, silver did something that many thought impossible. It shattered the historic $80 per ounce ceiling. It touched an intraday high of approximately $84. It broke through levels that had not been seen since the Hunt brothers era. The poor man's gold is being repriced as a premier asset in real time, and we are only in the early innings of this transformation. Now let me tell you what Wall Street is trying to do with this warning about forced selling. TD Securities, a major institutional player, has issued a report warning that silver currently accounts for about 9% of the Bloomberg Commodities Index. The target weight for 2026 is approximately 4%. This means that passive tracking funds that follow this index will need to rebalance. They will need to sell silver contracts to bring their allocation down to the target weight. The estimate is approximately $5 billion in selling pressure over the coming 2 weeks. TD Securities senior commodity strategist Daniel Gawley wrote that they expect a massive 13% of aggregate open interest in COMEX silver markets to be sold, resulting in a dramatic repricing lower. This sounds terrifying. This sounds like the rally is over. This sounds like you should sell immediately before the forced liquidation crushes the price, and that is exactly what they want you to think. But let me explain what is really happening here and why this is actually a gift for long-term silver bulls. First, understand what index rebalancing actually means. These are mechanical passive flows. They are not based on fundamentals. They are not a reflection of supply and demand. They are simply the result of silver outperforming so dramatically that its weight in the index has increased beyond the target allocation. The selling is predetermined and predictable. Every sophisticated trader knows it is coming. Every institution has already factored it into their models. The idea that this will somehow catch the market by surprise and cause a genuine crash is naive at best and manipulative at worst. Second, understand who will be buying what the passive funds are selling. The same institutions that have been accumulating physical silver for months, the same smart money that used the Christmas crash to load up on metal, the same industrial buyers who need silver for solar panels and electronics and cannot wait for lower prices. The forced selling creates an artificial dip that will be absorbed by real demand. It is a transfer of contracts from weak hands to strong hands. It is the market functioning exactly as it should. Third, look at what happened during the Christmas crash, because this is the template for what is about to unfold. Silver prices dropped nearly 10% in a single session during the holiday week. The headlines screamed about a crash. The paper traders panicked. The leveraged speculators got liquidated. But while the paper price was collapsing, look at what happened to physical holdings. The iShares Silver Trust, the largest silver ETF in the world, saw its physical metal holdings increase. As of late December, the trust held approximately 529 million ounces, roughly 6,300 tons of silver. This divergence tells you everything you need to know. While day traders were selling paper contracts, institutional investors were using the dip to accumulate physical metal. The smart money was buying what the scared money was selling, and the price recovered. The crash was a buying opportunity, not the end of the rally. The same pattern will repeat with the index rebalancing. The mechanical selling will create an artificial dip. The smart money will accumulate, and the price will recover because the fundamentals demand it. Now let me give you the fundamental picture that makes any short-term selling irrelevant. We are in the 5th consecutive year of global silver supply deficit. The world is consuming more silver than miners can produce. The annual deficit is estimated at roughly 117 million ounces. This is not a temporary imbalance. This is a structural shortage that cannot be resolved in the near term. Every ounce sold by a passive index fund is an ounce that will need to be bought back by an industrial consumer who has no choice but to pay any price. And the driver of this deficit is not going away. It is accelerating. The solar industry is undergoing a massive technological shift to TOPCon cells. These tunnel oxide passivated contact solar cells are more efficient at generating power, but they require significantly more silver paste to manufacture than previous models. The industrial burn rate is increasing at the exact moment when supply is constrained. Solar manufacturers must buy silver regardless of the cost. Their assembly lines depend on it. Their production schedules depend on it. Their contracts with customers depend on it. They are price inelastic buyers in a market with price inelastic supply. And the fundamental picture extends beyond solar. Look at the gold to silver ratio. For years, this ratio hovered near 100, meaning it took 100 ounces of silver to buy 1 ounce of gold. This was historically extreme. It signaled that silver was massively undervalued relative to gold. Today, that ratio has collapsed to approximately 58. This compression represents the market finally recognizing silver's true value. But historical norms suggest the ratio could fall even further. In previous bull markets, the ratio has reached 30 or even lower. If we see a move toward 40 or 30, silver would need to dramatically outperform from current levels. The Shanghai premium provides further evidence of the underlying strength. Physical silver in China is trading at a premium of more than 8 per ounce over Western spot prices. This is not a small arbitrage. This is a screaming signal that physical demand in the world's largest manufacturing economy is overwhelming supply. Traders are buying silver in London and New York and shipping it to Shanghai to capture this profit. This dynamic drains inventories in Western vaults. It tightens the supply available for funds like SLV. It creates a constant bid under the market that paper selling cannot overcome. And then we have the geopolitical dimension that exploded onto the scene this week. President Trump issued a direct warning to Iran in a Truth social post. If Iran shoots and violently kills peaceful protesters, which is their custom, the United States of America will come to their rescue. We are locked and loaded and ready to go. These are not diplomatic words. These are the words of a commander-in-chief signaling that military action is on the table. Silver is a safe haven asset. It performs well during times of geopolitical uncertainty. The threat of conflict between the United States and Iran adds another layer of demand that has nothing to do with index rebalancing. The Fed is providing the final tailwind. On December 10th, the Federal Reserve cut interest rates by 25 basis points. This signaled that the central bank is committed to an easing cycle. Lower interest rates weaken the US dollar. Since silver is priced in dollars, a weaker currency makes the metal cheaper for international buyers. It fuels global demand. It supports prices even when domestic selling pressure emerges. The monetary policy backdrop could not be more bullish for precious metals. So let me put this all together for you. Wall Street is warning about $5 billion in forced selling. They are telling you to expect a dramatic repricing lower. They are creating fear at the exact moment when fundamentals are strongest. But what are the facts? Silver just delivered its best year since 1979. The supply deficit is in its 5th consecutive year. Industrial demand is accelerating due to solar technology shifts. The gold to silver ratio has collapsed from 100 to 58. Shanghai premiums of 8 prove physical demand is overwhelming supply. The Fed is cutting rates and weakening the dollar. Geopolitical tensions are adding safe haven demand. And the Christmas crash already showed us that smart money buys when paper prices dip. The mining stocks are reflecting this reality. Cure Mining has posted year-to-date gains of approximately 222%. The company just announced an agreement to acquire New Gold Inc., a transformational deal that would create a premier producer with nearly $3 billion in projected EBITDA. The shareholder vote is scheduled for January 27, 2026. If approved, the merger provides economies of scale at the exact moment silver prices are peaking. Fresnillo, the world's largest primary silver producer, is exceeding production guidance at its Juanicipio mine with a 96% silver recovery rate. The operating leverage is massive. Every dollar increase in silver price flows almost entirely to the bottom line. The $80 level is not a ceiling, it is a floor. The break above this historic level was a psychological breakthrough that opens the path to triple-digit prices. The fundamentals support it. The supply deficit demands it. The industrial consumption requires it. Any pullback caused by mechanical index rebalancing is a gift for those who understand the bigger picture. This is how wealth transfers happen. The institutions issue scary reports about forced selling. The retail investors panic and sell at the lows. The institutions buy what retail sells, and then the price recovers and goes higher while retail watches from the sidelines. Do not be the retail investor who gets shaken out. Do not let a temporary, mechanical, predictable flow of index rebalancing convince you that the structural bull market is over. The deficit is not going away. The solar demand is not going away. The safe haven demand is not going away. The monetary policy tailwind is not going away. The trap is being set, but it is not a trap for the bulls. It is a trap for the shorts and the skeptics who think they can talk down a market that is fundamentally repricing. The poor man's gold is becoming the rich man's insurance. The overlooked metal is becoming the essential commodity. The 160% gain in 2025 was just the beginning. Hold your positions. Accumulate on any dip caused by index rebalancing. Understand that the smart money is on your side, and prepare for what could be the most explosive year in silver since the Hunt Brothers era. Like, subscribe, and share this with everyone who needs to understand the game being played. The trap is set. Make sure you are on the right side of it.